Owner's rights. The owner of the policy has certain rights. If you own insurance on yourself, you're both the owner and the insured. If you own insurance on yourself, you're the owner and you're the insured. Can I own insurance on my kids? Sure. So it's possible for in a family situation or maybe a business's needs, like key person life insurance, it's possible that we have third-party ownership as well. Third-party ownership. So I could own a policy, I could be the owner, and the insurance could be on my son, Max. So my son, Max, he is the insured. So who has the right to pay the premium? The owner does. Who has the right to select and or change the beneficiary? The owner does. Who has the right to select a non-forfeiture option? The owner does. Which I haven't even explained those to you, but I will. Dividend options, the owner has the right to choose dividend options. So these are all rights of the owner, and the owner's not always the insured. So that's really important. It's important. So when I own insurance on Max, I pay the premium. I can select and change the beneficiary. I can choose non-forfeiture. I can select the dividend options. Sometimes the owner is the insured, but whenever you're given a question, always owner's rights. It's a huge emphasis on your exam. Now, I said that one of the rights as an owner is to change the beneficiary, unless the beneficiary is what we call irrevocable. So most beneficiary designations are revocable. A revocable beneficiary means you can change it at any time, and that's really the default. That's what they are. Sometimes in a divorce settlement, your ex-spouse is named irrevocable primary beneficiary, because if you die, then you're not paying child support, and then that money's got to go to your ex-wife so she can raise the kids. It's usually done by court order. You usually don't love your spouse so much that you name them irrevocable. So you have the right to change the beneficiary as the owner of a policy unless the beneficiary is irrevocable. An irrevocable beneficiary cannot be changed, not without permission of the irrevocable beneficiary, which generally speaking, they would never give you the permission to change it. So owner's rights. Beneficiary designations, always on the test. So the beneficiary is who gets your death benefit. And there's two major categories. There's primary beneficiaries and then there's contingent. Now, we talked about revocable is what you want your beneficiary to be if you want to maintain all of your owner's rights. So always a question about that. Revocable just means you can change it at any time. Irrevocable, you can't change it. I'll be the insured. Susie, primary Bruce, my husband, and then contingent Miles, Mason, Max, and Emery. How in the world would the kids ever get my face amount? How would that happen? They'll say it like this on the test. If the primary beneficiary predeceases the insured, so if Bruce dies first, then I die, then the money is going to go to the contingent beneficiaries. In the story, my 4 kids. The only way that it's going to go to the contingent is if the primary predeceases the insured. So you want your beneficiaries to be revocable if you want to maintain all of your owner's rights. To buy insurance on someone, you have to have what we call insurable interest. That's going to come up in the course in a little while. But it's this idea that you can't just buy life insurance on anyone you might think would be a good idea. Who'd you buy life insurance on if you could buy life insurance on anyone? How about a race car driver? You can't do that. It's called gambling. You can buy insurance on yourself, your family, and a key person in your business. So you have to have insurable interest at time of application. Beneficiaries really can be anyone. Beneficiaries don't sign anything. They don't have to have insurable interest. You've heard weird stories where famous people leave all their money to their dogs. That happened before. There were stories after 9/11 where people were leaving their money to the New York Fire Department. So beneficiaries need not have insurable interest. Anybody can be named your beneficiary. They don't sign anything. Beneficiaries don't sign anything. There is something that's important as far as beneficiaries called the Common Disaster Clause. It's also called the Uniform States Common Disaster Clause or Uniform Simultaneous Death Law. So it works like this. Very oftentimes, when you're married, your primary beneficiary is your spouse. So let's pretend that Bruce and I actually went on vacation together by ourselves, because that's fairly unlikely to happen, but let's pretend we did. And we die in a plane crash. Now, I haven't told you something. Bruce has a will, but the only person set to inherit his will is his daughter from his first marriage. So there is a will, but the only person that's designated here is his daughter from his first marriage. So let's say we're in this accident. It's a horrible accident. I die right away. A couple days later, Bruce dies. Everything that Bruce owns, because of his will, goes to his daughter from his previous marriage. Okay, she's made up. This is not true. I can't tell you how many times students have told me, Susie, you really got to fix this. That's the only part of my story that I make up. So the way that this is, I'm up there in heaven and I'm thinking, really? This is not the point of this policy. I bought this policy to provide for these 4 munchkins of ours. So because I died first and Bruce died as a result of the same accident, the Uniform States Common Disaster Clause is going to say that the insured died last. So the insured died last. So Bruce died first, then I die, and the money goes to the contingent beneficiaries. So Common Disaster Clause protects the rights of the contingent beneficiaries. I'm sorry, previous daughter who I made up, but this money wasn't designed for her. It was designed for my family. So Common Disaster Clause. But we do have to die as a result of the same accident. And Bruce can't die 6 months later from the accident. It'll always be something like Susie the insured died, then a week later Bruce died. Common Disaster Clause is going to take effect. So the insured died last. Protects the rights of the contingent beneficiaries. Premium payments. We talked a little bit about the mode of payment, and if you pay the premium annually, it's less expensive than if you paid it monthly. So mode of payment is describing how often you make the premium payments. We're going to assume for the test annually. More often you pay, the more expensive it is because of service fees. What allows the insurance company to charge service fees? Mode of payment. Grace periods. Policies always have this period of time, life insurance policies have this period of time where even if you forgot to pay your premium, you are covered. You are covered during this time. So this is a period of time where coverage still applies, even though the premium payment has not yet been paid. Grace periods. If an insured dies during the grace period, they will have coverage. What will be paid is face amount minus the premium that should have been paid, plus interest, of course, owed on that premium. So you do need to know the grace period for individual life insurance policies is 30 days. Group is 31. Group life. Group is always better. It gets one extra day, 31 days. Industrial life, which really is not sold anymore, and I can't imagine you would ever see it on the test. This was a kind of life insurance where people paid weekly. It was collected door to door, 7 days in a week, 4 weeks in a month. It had a 28-day grace period. So you're going to have a question about grace periods. It'll go something like this. Annual premium $1,000, and the face amount's $100, and the premium is due on 12/1, and the insured forgot to pay the premium, so did not pay. And then on 12/15, the client died. Are they covered? Yes. How much is going to be paid? Face amounts? No. Face amount minus premiums, plus interest on the premiums. So face amount minus premiums is what is paid during the grace period. So they still have coverage. They still have coverage. What if they had died on 1/15? Would they have had coverage? No. They only have coverage on an individual life insurance policy during the grace period. It only lasts for 30 days. Group 31. Automatic premium loan rider. This is a rider that we did not cover first in this chapter because those riders like waiver of premium and guaranteed insurability, those all cost extra. This rider is free. But it must be selected by the client, and it can only be added to a whole life policy, can only exist on a cash value policy. So this idea that if you have automatic premium loan rider, if there's enough cash value in there to pay your premiums, then the policy will stay in force after the grace period has expired. So you can't have automatic premium loan rider on term insurance because there is no cash value. There has to be cash value in order for this rider to work. So on an individual policy, what's your grace period? 30 days. Are you covered during your grace period? Yes. So if you die, they'll pay your premiums. It doesn't matter if it's term or whole life, they'll always pay the premiums. But when you have automatic premium loan rider, this goes into effect if after the 30 days you still haven't paid your premium. So it creates a loan against your cash value. So face amount minus loan plus interest. So I have to make sure that I explain something properly. Grace periods apply on term and on whole life. So it has nothing to do with cash value. Automatic premium loan rider is the one that has to do with cash value. So that's the one that has the interest. So I kind of said that wrong. I don't want to confuse you, so I'm going to fix it. When you have a grace period and you die during the grace period, what's paid face amount minus premium. It applies on all policies. The only way automatic premium loan rider can exist, it's a little box that the client will check on the application that says, hey, if I forget to pay my premium and there's enough cash value to keep my policy in force, please take out a loan against my cash value. What's paid when I die, face amount minus loan plus interest on the loan. So I don't want to I needed to fix you because grace period has nothing to do with any interest because it's not a loan at all. So let me ask, if we have automatic premium loan rider on ordinary whole life, is it going to be of much good during the first 3 years? No, why? Because there is no cash value. There needs to be enough cash value to pay the premium and have interest accrue. When your premium is due, if you don't pay it, you do have your grace period. If you die during your grace period, policy coverage will apply. If you have a whole life policy and you have selected the automatic premium loan rider, if you forget to pay your premium after your grace period, the automatic premium loan rider will create a loan against your cash value and keep your policy in force for you. It will prevent the policy from going into what is called non-forfeiture, which I will explain in a moment. If your policy lapses after the grace period, and assuming there is no automatic premium loan rider on the policy, if the client wants to get back the policy, they need to reinstate the policy. So reinstatement. Generally, reinstatement is allowed for up to 5 years after a policy lapse. What does an insured need to do to reinstate the policy? They have to pass a physical. The insurance company is not dumb. They're not going to let you reinstate a policy that you let lapse. Now you found out you're sick and dying. They're not going to let you reinstate. You do have to pass a physical exam. You have to pay all your back premiums plus interest. So any premiums that you skipped, you have to pay those back. And you need to repay all policy loans plus interest. If there were any outstanding when you let the policy lapse. Why might it behoove you to reinstate your policy? Reinstatement gets back your original age. So I'll show you a story. So let's say you got a life insurance policy when you were 30, and when you were 50, you didn't pay your premium. You have on an individual life insurance policy a 30-day grace period. You don't have automatic premium loan rider, so your policy has lapsed. Here you are now, you're 53, and you think, that was kind of dumb. I want my life insurance back. You can go out there today at age 53, go through underwriting and purchase a new policy based upon your current or attained age. Or if you reinstate, pass a physical, pay your premiums, pay back all the policy loans, you get back the premium associated with your original age. So this is so important that reinstatement gets back your original age. In order to reinstate, you must pass a physical. They love that for your exam. So is it guaranteed that you'll be able to reinstate? Absolutely not. The insurance company has the right to say no. When you reinstate a policy, for example, let's say I have insurance on my husband, I'm the owner, I'm paying the premiums, he's the insured. We get divorced, I let the policy lapse, and I decide that I want to get it back. If we're friends enough that he'll go pass a physical, I can reinstate that lapsed policy. I do not have to have insurable interest to reinstate. You only need to have insurable interest at the original time of application. You do not need to have insurable interest when you reinstate the policy. When you reinstate the policy, your incontestability clause starts over, which we're going to learn about momentarily, as well as the suicide clause. The incontestability clause and the suicide clause both start over when you reinstate a policy. Policy loans. So when we have this whole life policy and we have this cash value, we have the ability to access this cash value in the amount of a loan. So let's say our cash value is $40,000 and we take out a loan of $10,000. When you take out a loan, the insurance company sends you their money and basically makes a note against your cash value. After your first year of having a loan outstanding, you should pay, or you will be asked to pay, interest on your loan. Now, you don't have to pay the interest back on your loan, but if you don't pay the interest, it will accrue and accrue and accrue, kind of like interest on your credit card. So that what's paid when you die is face amount minus loan plus interest on the loan. So you never have to pay the interest back. But there is this concept that the test likes. If I take out this loan, it's going to have interest. So there's going to be interest charged, of course. And if my cash value is $40,000, do you think I can take out a $40,000 loan? No, because there's nowhere for the interest to be, if you will. So the most you can take out in the form of a loan is cash value minus the interest. The most that you can take out in the form of a loan. So you can take out a loan on any cash value policy. You cannot take it out on term insurance because term insurance has no cash value. The maximum interest rate the insurance company can charge you on a loan is 8%. So how much they charge you, the most it can be is 8%, but it would be listed in your insurance policy how much your insurance company will charge you. If your cash value becomes 0, your policy will lapse. If your cash value becomes 0, your policy will lapse. So this idea that the interest will be charged, and if you don't pay it, it can't grow so large that your cash value becomes nothing, or you'll have no more coverage. You'd have no more protection. The test wants you to understand what are called non-forfeiture options. Non-forfeiture options. Non-forfeiture options apply to the cash value of a lapsed life insurance policy. So you don't have non-forfeiture options on term because there is no cash value. When you have a cash value policy, you forgot to pay your premium. What happens first? Grace period. If you don't have automatic premium loan rider, then your policy will lapse and go into this, what's called non-forfeiture. So when you have this cash value policy, you didn't pay your premium, your policy is lapsed, the insurance company would love to just keep your cash value and be like, haha, we got it, you can't have it. But they can't just do that. You have specific rights. You are not forfeiting your cash value. So that's what the title has to do with, not giving up your cash value. So they send you a letter describing your non-forfeiture options. And the letter says, "Dear Sir." Oh, I know that's not how you spell sir, but I can't tell you how helpful it is to have an acronym to help you remember what are your non-forfeiture options, because it's always a test question. So what do you want to do with your $40,000? Let's say that's your cash value. Your policy has lapsed. Your first non-forfeiture option is to take cash surrender. If you take cash surrender, there'll be no more coverage. If you take cash surrender, no more protection. So if your cash value is $40,000, and let's say you've paid in premiums of $35,000, and you take all of the cash value out, they send you a check for $40,000, $35,000 is your cost basis. The difference, the $5,000 difference, is your earnings. It's taxable as ordinary income. Anytime you take cash surrender and get out more than you put in, that is taxable. So in the beginning years of the policy, we said no cash value for the first 3 years. So let's say in the 5th year you took cash surrender and you got $1,000. You'd paid in $5,000, you got $1,000. Is that taxable? No. It's only when you take cash surrender and you get out more than you put in that you create a taxable event. So that's your first choice, to take cash surrender. What else could you do? The second one is called extended term. I'm going to put the last one up here, then I'll explain what these last two mean. Reduced paid up. So these are the 3 non-forfeiture options: cash surrender, extended term, and reduced paid up. Extended term is the automatic option if I don't tell the insurance company otherwise. If I don't tell the insurance company otherwise, they can't just keep my cash value and do nothing with it. What they do with this cash value is they use it as a single premium to buy me term insurance coverage. So extended term has the same face amount as the original policy. So in this case, the face amount is $100,000. So back to the original whole life policy story at the beginning of class. Extended term, uses this, so it uses the cash value as a premium, extends the face amount. So it's the same face amount that you already had. How long? For a period of time. You don't know how long. All you know is that it's for a period of time. It's no cash value. It's temporary insurance. So the $40,000 is going to go a whole lot farther if you're younger than it will go if you're older. They got to keep you, though, with the same face amount. So that's the automatic option if you don't choose otherwise. Reduce paid up, they're going to take this premium and they're going to use it as a single premium. Paid up is the type of whole life, paid up to age 100. So basically what you're saying is you're never paying another premium again. This premium is a single premium. Your face amount is less. So your face amount is less than $100,000. Extended term keeps you with the same amount of protection. Reduce paid up gets you less protection, but for a longer period of time. So these are the three. You have to know what the three are, and then you should know a little bit about how they work. So extended term default, that's what will happen if you don't choose otherwise. Reduce paid up, you have a reduced face amount. Sometimes they might ask you which one of these three provides the most protection. Now, if they ask you that, they're looking for the most face amount. So which one has the highest face amount? Extended term. Which one has the longest length of coverage? Reduced paid up. So that's whole life, but it has less protection. So when they say protection, they mean face amount. So be really careful with that. So know the three. Helps to remember CER. Dear sir, what do you want us to do with your cash value? They will always be on your test. Dividends and dividend options. Insurance companies are organized one of two ways. We have stock insurance companies and we have mutual insurance companies. So insurance companies that are stock insurance companies are owned by the stockholders. So that if a dividend is paid on a stock insurance company, the dividend goes to whom, do you think? Goes to the stockholder. So as a policyholder on a stock insurance company, you will never get the dividend. So that the policy that you purchase is what we call a non-participating policy. You will never, as a policyholder on a stock company, get the dividend. So stock companies issue non-participating policies. Non-participating in dividends, so non-par, we sometimes call that. Whereas mutual insurance companies are owned by the policy holders. So that if a dividend is paid, now remember, dividends are paid entirely at the discretion of the board of directors of the insurance company. They're viewed as a return of premium. If the insurance company is charged so much for premiums that after their expenses they have money left to pay you back, they must have charged you too much. That's the rationale behind the dividend. So it's not taxable, which is really nice. It's the only non-taxable dividend that there really exists out there. So that if you're the mutual policy holder, if the insurance company declares a dividend, the dividend is paid to you. Dividend paid to the policy holder. If you have a policy that was sold by a mutual insurance company, you have a participating policy. The insurance company may project dividends on a participating policy, but can never guarantee a dividend will be paid. Dividends are never guaranteed. They are paid entirely at the discretion of the board of directors. The insurance company cannot project a dividend on a non-participating policy. Okay, so let's see. You have a participating policy sold to you by a mutual insurance company, and you have the waiver premium rider. That's a lot going on. You're totally disabled, so your premiums are being waived during your total disability. Your life insurance policy is still in force. Question is, are you still going to get the dividends? Yes. If you have a participating policy, even though the waiver of premium rider has been enacted, you will still receive your dividends if one is paid. If one is paid. So your cash value grows more slowly, but you would still get your dividend.